want an exposure to a market or an
Everything they need in one place.
The world's foremost authority on individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and here with me today is Jacob de Tusch Lec, manager of the Artemis Global Income Fund. Hello Jacob.
Hey Emma.
So over the summer you've been reducing your European exposure, taking it down from around 45% to around 35%. Why is that?
It's, I think risk management is probably the way to look at it. When I went massively overweight Europe 3 years ago, Europe was very cheap, everybody had given up on the Eurozone, things couldn't get any worse. Now Europe is pretty much a mainstream long for a lot of funds. European equities are probably fair value. And when you look at the macro data, things aren't exactly great. We're sort of betting on things getting so bad that Draghi is going to bail us out again, but there is less and less ammunition. So I still have a very big portion of the fund in Europe where valuations are constructive at best, but it's no longer just a close your eyes and buy it environment we're in.
Because 35% is still more than the benchmark. Is it then, as you suggested, about being more tactical about your European allocation?
It's still very overweight compared to the benchmark, and I think more importantly within Eurozone, we're entering a time where buying the right countries makes sense again. I'm very overweight Southern Europe, which might be counterintuitive because it's still the risky place to be. But the ECB has made it clear that they're going to bail out Europe and bail out Southern Europe. So I think you've got a bit of a policy put in place in Southern Europe, whereas other parts of Europe are just getting the poor growth. The declining euro over the past couple of months might give a bit of a stimulus to the exporters in the north, the French and the German exporters, but I think it's going to be short-lived as we don't really see a global cyclical recovery or synchronized recovery. So I still think that Southern European carry trades is where I've put quite a lot of capital.
It might come as a surprise to investors who perhaps think the US is overvalued that you have actually been buying a couple of things in America. What opportunities are you seeing there?
Well, the thing about the US is that it's overvalued, but it's also by far the best economy in the world right now. And it's an economy that's normalized. They've really cut the banking system, cut the bad debts. They've done all the hard restructuring that we're struggling with in Europe and that Japan hasn't done for decades. So I think you've got to be quite selective in the US and know that you're not buying a lot for multiple expansion. When you buy something on a PE of 15 or 20, odds are it's not going to go to 25, but you can buy it for earnings growth, good management, good corporate governance, and an economy that's actually growing. So what I've been focusing on in the US are sort of good companies with a bit of a cyclical backdrop that can take advantage of the strong economy. And usually you can get those maybe at 16, 17 times. Buying cyclicals in Europe, they look cheap, but there might be value traps as Europe is moving closer to sort of the deflationary, recessionary environment.
And then because it is a global fund, what about your emerging markets allocation? I know you've been adding to that.
Yeah, so emerging markets is a tricky one because there's big differences between emerging markets. I mean, Brazil right now is all about the election. South Africa is all about basically stemming corruption and iron ore price. So there are a lot of different dynamics going on in emerging markets. What I like in emerging markets are sort of boring stocks. I tend to say when you go to emerging markets, don't buy an exciting stock because you get too much risk. So what we have is in Hong Kong, for example, we have a couple of utilities, some toll roads in China, pretty defensive industries, but still showing better growth than a toll road would, let's say, in Italy or in the US, because traffic growth in China is still double-digit in many areas.
And with that, does that come a growing dividend?
Yes, absolutely. I mean, if you think of a toll road, you build it and you get the tolls at the beginning or the end, and if the number of cars go up and the number of trucks goes up, you got pretty big volume increases. So that kind of operational gearing is what you still get in emerging markets. It's harder to get in Italy, for example, where traffic growth is about 1%.
Jacob, thank you very much. This is Emma Wall for Morningstar. Thank you for watching.